Most people think investing is something you start after you have a lot of money. They think investing is for rich people, Wall Street people, people with spreadsheets, golf memberships, and strong opinions about bond yields that nobody asked for. But here is the truth. You do not need to be rich to start investing. You need to start. That is the part most people miss. One of the biggest investing mistakes beginners make is waiting until they have enough money. They say, "I'll start investing when I make more. I'll start when I have thousands saved. I'll start when life calms down. I'll start when I understand everything." And then 5 years go by. 10 years go by. And they are still waiting. Meanwhile, the person who started small is building the habit, gaining confidence, and giving time a chance to work. So today we're breaking down how to start investing with little money. Not how to get rich overnight. Not how to pick the next hot stock. Not how to turn $50 into a yacht by Thursday. Just a simple beginner investing plan that helps you start building wealth without needing a huge income. First, understand what investing really is. Investing is ownership. When you invest, you are buying small pieces of assets. That could mean businesses, funds, real estate funds, or retirement investments. The goal is to put your money somewhere it has the chance to grow over time. That is very different from spending money on things that disappear the second you buy them. A meal is gone. A random online order is gone. A shirt you bought because you were bored eventually ends up in the back of your closet, judging you silently. But an investment has the chance to keep working. That is why investing matters. It turns money from something you only spend into something that may grow. Now, before you invest, build a basic foundation. This does not mean your life has to be perfect. If everyone waited for perfect, nobody would invest except monks and robots. But you should have a small emergency fund. You should be paying your bills on time. And if you have high-interest credit card debt, that needs serious attention. Because investing while paying brutal credit card interest is like filling a bucket while someone drills holes in the bottom and charges you for the drill. You can still learn. You can still prepare. But high-interest debt is usually the first fire to put out. Once you have some stability, start smaller than you think. A lot of beginners say, "What is $50 going to do?" But that is the wrong question. The first $50 teaches you to start. The first $100 teaches you consistency. The first automatic investment teaches your money where to go before you waste it. Small amounts matter because habits matter. You are not just building an investment account. You are building the identity of someone who invests. And the person who invests $50 a month is much more likely to become the person who invests $500 a month later. The person waiting for the perfect moment may still be waiting while their money gets ambushed by food delivery, subscriptions, and mystery Amazon boxes. Next, choose the right type of account. For many people, the easiest place to start is a retirement account. If your employer offers a 401k, especially with a company match, look into it. A match is basically extra money toward your future. And extra money is one of my favorite types of money. If you do not have a workplace plan, you may be able to look at an IRA or Roth IRA depending on your situation. The point is not to become a retirement account expert today. The point is to understand that retirement accounts can be powerful tools for long-term wealth building. They give your investing structure. And structure matters. Because unstructured money has a habit of wandering off and joining a lifestyle upgrade. Now let's talk about what to invest in. For most beginners, simple usually beats clever. You do not need to pick individual stocks. You do not need to chase whatever stock social media is screaming about. You do not need to become the person at dinner explaining why a company is undervalued, while everyone else is just trying to enjoy chips and salsa. A simple beginner approach is broad market investing. That usually means index funds or ETFs that hold many companies inside one investment. Instead of trying to guess which one company will win, you own a broad basket. That gives you diversification. Diversification is just a fancy way of saying, do not put your entire financial future on one horse wearing sunglasses. When you buy one individual stock, you depend heavily on one company. When you buy a broad fund, you spread the risk across many companies. That does not mean it cannot go down. Investing always has risk. The market will have bad days, bad months, sometimes bad years. But broad long-term investing helps beginners avoid betting everything on hype. And hype is dangerous. Hype makes people buy high, panic low, and then tell their family they were early, which is finance language for "this hurts." Next, automate it. Pick an amount you can actually stick with. $25 a week, $50 a month, $100 a month. Whatever fits your life. Then automate it if possible. Make investing boring. Boring investing is underrated. Boring investing does not give you dramatic stories. But dramatic stories are often where money goes to die. The goal is not excitement. The goal is consistency. Every payday, money goes toward your future before your present tries to eat all of it. Because your present has expensive taste. Another important rule is do not try to time the market. Beginners often think they need to wait for the perfect time to invest. They wait for prices to drop. Then prices drop and they get scared. Then prices rise and they feel like they missed it. Then they wait again. This becomes a financial merry-go-round, except somehow less fun and more expensive. Nobody knows exactly what the market will do next week. Not the guy online with the chart. Not the financial news host. Not your cousin who bought crypto once and now speaks in riddles. That is why many long-term investors keep it simple. Same amount. Same schedule. Good market. Bad market. Boring market. This helps remove emotion from the decision. And emotion is where beginners often get wrecked. Now here is what to avoid. Avoid investing money you need soon. If you need the money for rent, bills, car repairs, or emergency savings, that money probably should not be in the market. Investing is for money you can leave alone. Because markets move. And if you need the money right when the market is down, you may be forced to sell at the worst time. Also avoid chasing quick wins, hot stocks, meme coins, options trading, random tips from strangers. Anything promising fast, easy money should make your financial alarm bells start screaming. There is a big difference between investing and gambling in a nicer outfit. Investing is a plan. Gambling is hoping chaos likes you. And chaos is not your friend. So here is the simple starter plan. Build a small emergency fund. Deal with high-interest debt. Choose an investing account. Start with a realistic amount. Keep it simple with broad index funds or ETFs. Avoid hype. Avoid panic. Automate your contributions. Then increase the amount as your income grows. Every raise, bonus, debt payoff, or expense you eliminate can help you invest more. That is how small investing becomes serious wealth building. You start where you are. Then you level up. The key is patience. Investing is not a microwave. It is a crock-pot, which is unfortunate because microwaves are exciting and crock-pots are basically furniture that smells like soup. But wealth usually builds slowly. Then suddenly. At first, the numbers may look small. That is normal. The early stage is about building the habit. Later, the habit builds the account. So do not be embarrassed to start small. Be embarrassed to never start because you were waiting to look impressive. The person investing $50 is ahead of the person waiting for the perfect moment. Because perfect moments are rare. Paydays are regular. Use them. You do not need to be rich to start investing. You need a plan. You need consistency. You need patience. And you need to stop believing that investing is only for people who already have money. Investing is one of the ways regular people start building money. Not overnight, not magically, but steadily. That is the wealth fix. If you want quick, simple money moves for investing, saving money, building wealth, paying off debt, improving your money habits, and living better without pretending you hate nice things, subscribe to 10-Minute Wealth Fix.